the market's secret language. Right now, professional traders are making consistent profits while beginners are losing money on the same exact market. What's the difference? They're reading something most people can't see. It's not insider information. It's not a secret algorithm. It's right there on the chart, hiding in plain sight. It's called technical analysis, and once you understand it, charts stop looking like random noise and start revealing exactly where price wants to go next. Today we're breaking down technical analysis in the simplest way possible. No jargon, no complexity, just the pure fundamentals you need to start reading markets like a pro. This is the Chain Catalyst, where we make the complex simple. The definition, what technical analysis really is. So what exactly is technical analysis? Here's the simple definition. Technical analysis is the study of past price movements to predict future price direction. That's it. Instead of asking, what is this asset worth? Like fundamental analysts do, technical analysts ask, what is price doing and what has it done before in similar situations? Think of it like weather forecasting. Meteorologists don't create the weather. They observe patterns, study historical data, and make predictions based on what usually happens when certain conditions align. Technical analysts do the same thing with markets. We observe how price moves, where it gets rejected, where it finds support, what patterns form before big moves, how volume confirms or denies those moves. And we use that information to make high-probability predictions about what happens next. The market isn't random. Human behavior isn't random. And since markets are driven by human behavior, patterns repeat. Technical analysis is the framework for identifying those patterns before they play out. The core principle, why it works. Now here's why technical analysis actually works, and why it's not just voodoo like some people claim. Markets move on three things: fear, greed, and information. Fear and greed are emotions, and emotions create predictable patterns. When traders get scared, they panic sell at support levels. When they get greedy, they FOMO buy at resistance levels. When uncertainty hits, they create consolidation zones. These reactions have happened for hundreds of years. They happened in the 1920 stock market. They happened in the 2000s dot-com bubble. They're happening right now in crypto and forex. The three core assumptions of technical analysis. 1. Price discounts everything. Everything that can affect price, news, earnings, sentiment, fundamentals, is already reflected in the current price. You don't need to know why price is moving. You just need to see that it's moving and how. 2. Price moves and trends. Markets don't move randomly. They trend. Up, down, or sideways, but they trend. Once a trend is established, it's more likely to continue than reverse. This is the foundation of technical trading. 3. History repeats itself. Human psychology doesn't change. The same fear that caused a crash in 1987 causes crashes today. The same greed that fueled bubbles a century ago fuels them now. Because the patterns repeat, we can study them and anticipate them. This isn't magic. It's pattern recognition backed by psychology and probability. The three pillars, what technical analysts actually study. Technical analysis breaks down into three main categories. Master these and you've got the foundation. Pillar 1. Price action. This is the purest form of technical analysis. No indicators. No verles. Just raw price movement. Price action traders study support and resistance, where price historically bounces or gets rejected. Trend lines, the directional flow of price over time. Chart patterns, triangles, head and shoulders, flags, formations that signal what's coming next. Candlestick patterns, the psychology captured in every single candle. When you understand price action, you're reading the market story in real time. You see where buyers and sellers are fighting. You identify zones where big players have positioned themselves. You anticipate reversals before they happen. Pillar 2. Indicators and oscillators. These are mathematical calculations derived from price and volume. Common ones include moving averages, show the average price over time, smoothing out noise to reveal trend. RSI, Relative Strength Index, measures whether an asset is overbought or oversold. MACD, shows momentum and potential trend changes. Volume, confirms whether a price move has real strength behind it. Here's the key, indicators are tools, not crystal balls. They help confirm what price action is already showing you. They don't predict the future, they interpret the present. The mistake beginners make? Loading 10 indicators on a chart hoping one will tell them exactly when to buy. Professionals use 2 to 3 indicators maximum, and only as confirmation for what they already see in price. Pillar 3. Market structure. This is about understanding the bigger picture. Trend analysis. Are we in an uptrend, downtrend, or range? Higher highs and higher lows, the signature of an uptrend. Lower highs and lower lows, the signature of a downtrend. Key levels. The price zones where institutional money tends to act. Time frame analysis. How the 5-minute chart relates to the daily chart. Market structure tells you the context. Is this a pullback in a healthy uptrend, or the start of a reversal? Is this breakout likely to hold, or is it a trap? Without understanding structure, you're trading blind. Technical versus fundamental analysis. The key difference. People always ask, should I use technical analysis or fundamental analysis? Here's the truth. They answer different questions. Fundamental analysis asks, what is this company/asset actually worth? Are earnings growing? Is the business model sustainable? What's the long-term value? It's about intrinsic value. Great for long-term investing and understanding what you own. Technical analysis asks, what is price doing right now? Where are buyers and sellers positioned? What does the trend tell us? When is the optimal entry or exit? It's about price movement and timing. Great for trading and short to medium-term decisions. Think of it this way. Fundamental analysis tells you what to buy. Technical analysis tells you when to buy it. The most successful traders often use both. Fundamentals for asset selection. Technicals for trade execution. But if you're actively trading, day trading, swing trading, scalping, technical analysis is your primary weapon. Because in the short term, price doesn't care about fundamentals. It cares about supply, demand, and psychology. Practical application. How to actually use it. So how do you actually apply technical analysis in real trading? Step 1. Identify the trend. Pull up your chart. Zoom out. Is price making higher highs and higher lows? Uptrend. Lower highs and lower lows? Downtrend. Choppy going nowhere? Range. Never fight the trend. This is rule number 1. Step 2. Mark key levels. Find the zones where price has historically bounced or reversed. These are your support and resistance levels. Draw them on your chart. These are battlegrounds where decisions get made. Step 3. Wait for a setup. This is where patience separates winners from losers. You're waiting for price to approach a key level, form a pattern, and show you a signal. Maybe it's a bullish engulfing candle at support. Maybe it's RSI showing oversold while price bounces off a trend line. Maybe it's a triangle breakout with volume confirmation. You're not guessing. You're waiting for the market to show its hand. Step 4. Confirm with multiple factors. Never trade on one signal alone. Look for confluence. Price action plus indicator confirmation. Key level plus candlestick pattern. Trend alignment plus volume validation. The more factors lining up, the higher the probability. Step 5. Execute with risk management. Enter your trade with a clear plan. Entry price. Stop loss where you're wrong. Take profit target where you're right. Technical analysis tells you where to enter. But risk management determines whether you survive. This is the process. Repeat it. Refine it. Master it. Common mistakes. What beginners get wrong. Let's talk about the mistakes that kill most beginners. Mistake number 1. Indicator overload. Loading 15 indicators on one chart doesn't make you more accurate. It makes you confused. Keep it simple. Price action first, 2 to 3 indicators for confirmation. Mistake number 2. Ignoring higher time frames. You're trading the 5-minute chart, but the daily chart is in a strong downtrend. Guess what wins? The higher time frame always wins. Check multiple time frames before making decisions. Mistake number 3. Trading every setup. Just because you see a pattern doesn't mean you have to trade it. Wait for high probability setups at key levels. Quality over quantity. Mistake number 4. No risk management. Technical analysis can tell you where to enter. But if you don't manage risk, one bad trade can wipe out 10 good ones. Always use stop losses. Always size positions properly. Mistake number 5. Expecting perfection. Technical analysis doesn't predict the future with 100% accuracy. It gives you probabilities. You'll have losing trades. That's normal. The goal is to win more than you lose and cut losses quickly when you're wrong. Avoid these mistakes and you're already ahead of 90% of beginners. Closing, your next step. So let's recap. Technical analysis is the study of price movement to predict future direction. It works because human psychology creates repeating patterns. It's built on 3 pillars: price action, indicators, and market structure. You don't need a finance degree to use it. You don't need expensive software. You just need to understand the principles and practice reading charts. Start simple. Learn to identify trends. Mark support and resistance. Study basic candlestick patterns. Add 1 or 2 indicators for confirmation. Practice on historical charts before risking real money. Build your pattern recognition. Train your eye. Here's my question for you. Are you currently using technical analysis in your trading? If yes, what's your biggest challenge with it? If no, what's been holding you back from learning it? Drop your answer in the comments. I want to hear from you. And if you want to keep building your technical analysis skills with clear, no BS explanations, hit that subscribe button. Because here on the Chain Catalyst, we don't just show you charts. We teach you how to read them. Master the technicals and the market becomes a lot less mysterious. I'll see you in the next one. And card. Next video tease. The 3 technical patterns that predict 80% of market moves. CTA. Subscribe, turn on notifications, comment your technical analysis question.